I used to be involved with over 10 years, three different situations where the officer stole money from the league. And you always read it in the newspaper. Youth sports leagues always get ripped off by, the guy that's running it. And ultimately, in our league, it had to do with the fact that the president or the treasurer got the bank statements, right? The bank statements were under their control. They got the cash. They made all the deposits. They wrote all the checks, and they signed all the checks. So ultimately, just a simple step of the fact that they received the bank statements, would have been a very simple way to have figured out much earlier. When I was a kid, my dad's a CPA as well. He's retired now, but he's a CPA as well. He always worked alone. But what's very common as with attorneys is a lot of these guys do office sharing deals. So they're not partners, but they'll go into an office and they'll share, the receptionist and the IT and all that kind of stuff. Well, there was no IT back then, but so my dad was working with some guys for like 7, 8, 9 years, and they ultimately decided, they started, all the clients knew them, they were sharing all the employees, so they decided they were going to form a partnership, a true partnership, and work as partners. And so one guy was elected as, the managing partner, and they were going to rotate every year. So I went to the bank, they leased the building, went to the bank, got a $40,000 loan, and started doing build-out. And one day, innocently, my dad got the mail and opened up the bank statement and saw that the one partner had taken the $40,000. He'd drawn the line, he tapped it out, and they hadn't even started doing the construction yet. And again, it was just a very innocent thing. I remember that because that was like on a Friday, and on Saturday my brother and I were moving my dad out of the office. And ultimately another guy, the third partner, he had a tragic thing. Both his kids died within a year, and he just went off and paid the loan. He didn't want any trouble in his life. He just went, but just an innocent thing. Open up a statement and go, wait a minute, I thought we had X, and that's ultimately in the football leagues. It's when we got to a point where a check bounced. I said, wait a minute, I thought we made 20 grand at the tournament last week. I thought we had money left over from last year, right? Well, if somebody had been looking at the statement, so very simple, okay? Now there's all kinds of different internal controls, okay? Before you process an invoice, you match, you require purchase orders for everything. You require warehouse people to fill out receiving tickets. You require an accounts payable clerk to match a purchase order, a receiving ticket with an invoice. When all three come together, you say, yeah, it was approved to be ordered, it was received, and I'm being billed for what I ordered. Okay? So that's how, but ultimately that's your responsibility as managers. Now, it's to safeguard your assets. Cash ultimately is your number one asset. We talked about auditing of internal controls and all that last week, so I'm not going to repeat that. Accountants can also function as auditors. As auditors, as certified public accountants, we are governed by, in this state, the Department of Professional Regulation, okay? And in particular, there's a Board of Accountancy, which is a subsection of the DPBR. So not dissimilar to other professions, attorneys, engineers, contractors, etc. Okay, so that's how we're governed. We're also governed by the SEC to the extent that we're dealing with public companies, and we may be subject to even regulation within our own guild by the AICPA, depending on the type of work that we do. Our techniques are governed by something called GAS, Generally Accepted Auditing Standards. Those have typically been promulgated over the years by groups affiliated or associated with the AICPA. Okay, so GAS, Generally Accepted Auditing Standards. There's an expectation gap that we talk about, expectation gap. I've mentioned this before. In the view of most people in the public, the perception is that auditors are there to detect fraud, when in fact auditors come in to issue opinions on the fairness of financial statements. And their audit techniques are structured around determining whether those financial statements are fairly stated or not. Their techniques are not forensic techniques that are meant to detect or identify fraud. Now, there are certain frauds, there are times when people suspect fraud that one may come in and do specific forensic techniques that can help identify whether there's fraud or not. But what the public perceives, or most people in the public perceive, that auditors' responsibility is really not what they're contracted or hired to do or regulated to do.
Sorry, Professor, can you repeat guys as generally accepted?
Auditing standards. Auditors are going to come in, we talked about last week, they're going to review internal controls. They may or may not depend on them. But what auditors are going to do is they're going to come in and expect that you are able to detail what the internal controls in place are. Okay, to the extent that they can rely on them, your audit fee is going to be lower. To the extent that they cannot rely on them, your audit fee is going to be higher. More important than all of that, ultimately, in order to issue an opinion on the financial statements, the auditors are going to ask you for a management representation letter. And in that management representation letter, you will make positive affirmations about everything that is included in your financial statements, and negative affirmations as well. You will affirm that, in fact, all the transactions related to your trade or business are reflected in this book of record. That all bank accounts are properly recorded. That there are no related party transactions, or to the extent that there are, that you've identified them in the financial statements. That there are no subsequent events that may have a material effect on the financial statements. Or that if there are, that you have properly disclosed them. Okay? That you have properly documented and detailed all the estimates that you've used, etc. You will be asked, has anybody signed a management rep letter here? It's a pretty frightening thing, because you're kind of putting your neck on the line. They'll be 7, 8 pages long, and you're making affirmations to the auditors in regards to those statements. And basically, they're going to come back and say, this is what I was given. Well, how come you didn't know that these transactions weren't recorded? Well, these were the bank accounts that I was given. Management told me these were the only bank accounts that were, that had activities related to the business. Well, how come you didn't, detail this related party transaction? Well, management told me there were no other related party transactions other than the ones that are, detailed in the statement. So, ultimately, it comes back on you. Okay, so.
What's an example of a negative affirmation?
That you're not aware of any, say, contingencies that should be recognized as liabilities in the books of the company, for example. That you're not aware of any related party transactions that should be reflected. Positive would be all related party transactions are reflected. Yes, ma'am.
You said that the letter is to the auditors? And
yeah, it's called a management representation letter.
From just management?
It's from management. It's a management representation letter. So, as I said last week, auditors send a letter to counsel, right? They'll come in and they'll take a look at all of the legal bills that have been paid, and they'll send a letter to all the attorneys that have been engaged and ask them if there are any contingencies or commitments or legal matters that they've handled on behalf of the company. And it will get their assessment to the extent that those have not been settled. Footnotes and financial statements belong to the company. So management is responsible for those. The auditors report, we've talked about this before, report to shareholders. If there's a board, they'll report to the board as a proxy for the auditors. Auditors report to shareholders. The question is, does their opinion extend beyond that? So, if I read a Lennar financial statement, am I covered by that opinion?
Sure.
You say yes. Yeah, and that's a big legal question, right? So the question is, I'm a third party, I haven't paid you for that service, how can I rely on it? But where the courts have kind of come down is, you know, that report extends into the public domain. That report's issued, it is issued to shareholders, but to the extent that it's circulated, third parties that rely on that opinion are also covered by the report. Maybe not directly, but indirectly. Auditors have one obligation, well, multiple obligations. The one obligation they have is to be independent. Independent not only in fact, but in appearance as well. So, what does that mean? That means that we cannot have business relationships or transactions with the companies that we're auditing. Ultimately, there's one significant distinction between an auditor and an attorney. An attorney is an advocate. What's an advocate? He fights for you. So if I go to an attorney and I say, I want to sue that SOB, he's going to show me how to do it. And listen, I'm exaggerating, but I've lived this, right? I've had bosses that call an attorney and say, hey, let's sue those guys. That piece of machinery is garbage, blah, blah, blah. Ooh, big lawsuit, you know, like the next day. The guy doesn't, he's advocating for his client. Accountants have an obligation to be independent, which means, and it puts you as an accountant in an awkward position, because if you don't agree with a client, you have an obligation to tell him that. Ethically, and I don't just mean ethically in a theoretical perspective, ethically by GAS, which is embodied in what the Board of Accountancy requires, right? We're required to be independent. And independence means telling your client, listen, this should be accounted this way. You know, you're wrong. And it means withholding an opinion or qualifying an opinion on financial statements if you can't come, or resigning from an account. And I'm not going to get into all, you know, who owns records and documents and all that kind of stuff. There's a whole bunch of other stuff. But ultimately, you need to be independent. You cannot gain economically from a transaction with your client, or even give the appearance that you could gain. So, you'll see attorneys serve on boards of companies. You'll never see an accountant serve on a board of a company. Yes, Alex?
Like personal gain, like for yourself, like
As opposed to,
I mean, just saying,
like, gain for the greater good or society? Who does that? No,
Why would anyone want to be an accountant?
I love it.
I mean,
Because it's my calling. I mean, I don't know, because, I mean, why would somebody want to be a
the
contractor?
least popular person in the company.
No, listen,
Here it comes. Tell me. I mean, did something wrong or?
well, listen, that was always the joke, you know, like, you know, we used to have these big bags, you know, and people would run. You'd come in with these bags and people would just run. Yeah, I mean, to a certain extent, it's a necessary evil, and it's kind of an awkward relationship. And hopefully you add enough value that the client respects your perspective, you know, and just the difference is you can help your client without necessarily being his advocate while continuing to be independent, right? You know, I think in our personal lives we can appreciate friends who tell us things we don't want to hear. There's a way to say that, right? You know, you won't be friends with somebody who's always criticizing you, but you may find that you're friends with people who tell you the truth even when you don't like it, because you trust, you know, or respect that person. And hopefully with your auditor you can have that same sort of relationship that you say, hey, I may not like him all the time, but I respect him, and I need one, and this is one that I trust. And I know that he's not, you know, to your point, yeah, I mean, I say personal gain, but really, as auditors, you don't want to have any.
yeah.
And it extends beyond you, it extends to your family, you know, so, you know, your wife can't serve on the board of a company you're auditing. And it may be an honorary role. But you can't do it. Can't do it. And, you know, there's all kinds of things about, you know, audit partners have to rotate off clients after X number of years, because the presumption is you've been working with one client so many years, you become friends with them, you know, you might be impacted. Listen, part of the issues we're going to talk about later today, like Enron, ultimately had to do with breaches at a company level, but the fact that auditors didn't come in and do their job. So, we can bayonet the auditors, you know, ultimately it's management's responsibility, but the auditors have an obligation, and that's what they're paid to do. Okay? So, perfect. So, summary. Golden rule. What's the golden rule?
Don't be an accountant.
Do unto others as you would have them do unto you. Okay? You know, so anyway. We are going to take a 30-minute break at 1:25.
Oh,
No, one.
I'll be excited to leave right now. Go eat.
What?
What?
At 1:25, we'll start again.
Oh.
Exactly.